Hi everyone, Piers Bolger here, the Chief Investment Officer at Viridian. Well, financial markets obviously continue to be very volatile and challenging for investors. And we really thought today that it might be worthwhile actually just stopping and reflecting as to why we should be considering investing in equities principally as an asset class and the value that equities can bring to the overall performance of a portfolio. And when we think about equity investing, we don't think of it in the context of the market environment in the short term. The value that you get out of investing in equities and what it brings to a portfolio is that longer term capital growth. And associated with that capital growth is also the income that can be derived from investing in equities. Clearly, financial markets and equity markets particularly tend to be more volatile than other types of asset classes. And the reason for that is that you're ultimately investing in companies. And market environments, economic environments, industry structures, all those elements have an important role in how those companies evolve and how those companies deliver performance through those particular periods. At the moment, we're clearly seeing a very challenging period for the airline industry as an example. Consumer discretionary, retail, energy, all of these sectors are being impacted by what's occurring on a global footprint. It doesn't mean that those sectors are always going to be impaired. It doesn't always mean that those sectors can't deliver a good, solid investment return by the underlying companies that are represented within it. And one way to think about this when you then extrapolate that and think about that in the context of the broader market environment is just to look at the performance of equity markets over the longer term. And the first chart here just shows you the calendar year performance of the ASX 200, the domestic Australian equity market, total return that we've seen from 1990. And just a couple of points to note around that. First and foremost, we've seen both good and bad performance historically. And when we take the performance to date, we should be looking at that in the context that you should expect negative returns when investing in equity markets over the period. Equally, I think probably more importantly, when you look at the average return that we've seen over that last 20-year period, it's just been under 10%. So when people talk about trying to time the market, this is really what we're referring to in the context of investing in an asset class for growth for the longer term. Not getting caught up in what is the short-term market volatility that often occurs when investors are unknowing as to what the future might look like. But we have seen periods like this before, and we have seen financial markets continue to evolve and do better once they're out of those periods. We believe current environment is no different. What causes the instability and volatility that we see in equity markets can vary from period to period, but ultimately, and as we've spoken about this previously, we do believe that what we're facing into at the moment in terms of the coronavirus, the impact it's having on economic activity, the impact it's having on investor confidence and ultimately financial market performance is cyclical in nature. So this first chart I think should be taken just to think about what are we trying to achieve when investing, particularly in equities, and then start to balance that with what performance has occurred previously. The other important point to note on the chart is that 80% of the last 20 years, so 16 of the last 20 years, we've seen a positive performance out of equities. So even though we're facing into what is a very challenging first half of 2020, it doesn't necessitate that we'll have a negative return for the entirety of the year. It may, but it also doesn't necessitate that what we're seeing at the moment is going to continue on over many years to come. Our view is that ultimately the value that you'll see in equities will be delivered. And the second chart really highlights that point. The second chart that you can see here is just reflecting that valuation mix between investing in equities over bonds. Now, we certainly believe bonds have an important role to play in an investment portfolio, and the dampening of that overall volatility is really important when trying to balance out the entirety of that investment return through a full cycle. But this chart here is just giving you a bit of a snapshot in one way that we think about the valuation approach that we take to investing either in equities or fixed income or bonds. You can see here that when the line here is above that red dotted line, equities are expensive. When it's below, it reflects that equities are undervalued relative to bonds. And we're comparing the yield on equities versus the 10-year Australian bond within this chart. As you can see, as equity markets have continued to deteriorate over the last little while, it's becoming what we would say is more undervalued relative to the bond market. As I said, it's just one measure that we look at, but there are clearly periods, 2008, as well as back in 2000, where the equity market was overvalued, and clearly we saw a correction in that context. So again, from our perspective, when thinking about the performance of equity markets, and certainly as we go through this period, we also need to have one eye on the future and one eye around the valuation metric and the opportunities that we believe will be present as we work through the challenges of the coronavirus and the impact that that will have on the economy and certainly on financial markets in the short term. And as we've spoken about in other previous videos, the stimulus packages that we're seeing at the moment and continue to see from central banks and governments worldwide, we believe will provide a very strong backdrop to the recovery, most likely through the second half of this year, but provide also a strong backdrop to financial market performance. And part of that financial market will equally be the performance of equities. So balancing that longer term thought process with the valuation metric, obviously being cognizant of the market environment we're in, we certainly do believe that equities will continue to play a very important role in clients' portfolios and a very important role in delivering and generating wealth for the long term. As always, if you've got any concerns, please feel free to reach out to your advisor. And as I said, we'll continue to provide these videos and keep you up to date with our thoughts on financial markets. Bye for now.